Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of the Williams Company Inc., ticker symbol WMB. We're looking at Williams today because the business is an energy business that's outperformed the market over the past year. Currently, the business is trading for $31.51 per share, and over the past year, their stock price is up 8%. While the S&P 500 is down over this period. Additionally, Williams currently pays out a 5.4% dividend yield, which is well above that of the yield of an S&P 500 ETF. So we want to analyze the business today to understand what are we missing? What could the market have possibly discovered about this business that's led to this kind of outperformance? So over the last 5 years, Williams is about flat. Their stock price is down only 3%. Over 10 years, their stock price is down 8% in total. However, going back prior to the global financial crisis, over the last nearly 18 years, Williams is up at a rate of 4% compounded annually. Keep in mind that the company pays out dividends, and their average dividend yield throughout this period would be in addition to this compounded annual return. So right now, Williams is about $3 above their 52-week low. They're down about $6 from their 52-week high. And this is a large business. They have a $38 billion market cap. For additional background about the business, Williams is a midstream energy company that owns and operates the large Transco and Northwest pipeline systems and associated natural gas processing, gathering, and storage assets. In August of 2018, the firm acquired the remaining 26% ownership of its limited partner, Williams Partners. The company owns and operates 30,000 miles of pipelines, 29 processing facilities, 7 fractionation facilities, and approximately 23 million barrels of natural gas liquid storage capacity. The Williams Companies Inc. was founded in 1908 and is headquartered in Tulsa, Oklahoma. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Williams based off of their business fundamentals. This analysis is still a work in progress, and it serves as an opportunity to learn in public, so it will continue to improve and get better over time. With that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. So Williams, as a natural gas pipeline business operating in the midstream sector, is going to have pretty modest returns on capital. While they have been increasing steadily almost in all 5 of these years, and they're up at about 7% over their last 12 months, averaged out, the company is only producing about 5.5% average returns on capital. So this is slightly below the returns of a typical business, and this is well below that 14% benchmark. So this is an X here on metric number 1. It's not necessarily surprising because these pipeline businesses tend to be very asset intensive, but at the same time are likely pretty stable businesses as well. So it would be more difficult for operators in this industry to potentially earn outsized returns on capital. Next up for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of these is down, this entire metric will be an X. We'll also be including their last 12 months worth of numbers in our calculations here. So throughout this time frame, Williams has grown their revenues by about 43%. At the same time, it would look like their earnings are down. However, their 2017 was atypical because the business had an income tax credit. So if we were to exclude that, their net incomes over this period would actually be up. So we're going to make a slight adjustment and give that to them based off that one-time occurrence in 2017. And then at the same time, their free cash flows have grown by more than 5 times. So they are up massively. Looking at their free cash flow statement, we can see that this is both a combination of cash from operations increasing for the company, and then the business has also reduced their capital expenditures in recent years. So that's led to this very strong free cash flow growth. You would want to be mindful to understand whether this decrease in their capex is potentially over-earning for the business, or if it's because they pulled back to now being in a spot of only maintenance capex. They still spent $1.8 billion on capital expenditures over their last 12 months, so that's still a lot of money, but just something you want to be mindful of here. So it's potentially great to see such strong free cash flow growth for the business because free cash flow is really the lifeblood of any company, and a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. So a business can use its free cash flows to reinvest back into the business, make acquisitions, buy back shares, pay down debt, or pay dividends. It's great to see such strong growth across the board here for Williams, and this is our first check of the day coming in here on metric number 2. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Williams on a per share basis. So we're looking for earnings per share growth over the last 5 years. In the last metric, we learned that their earnings are actually slightly down over this period. However, that was due to a one-time income tax credit in 2017. So excluding that, the business's earnings would actually be up. However, their earnings per share are still going to be down because over the last 5 years, Williams has diluted existing shareholders in their business by 47%. When we look at the company's shares outstanding, we've seen that they've increased in all 5 of these years. However, there was a major uptick from 2018 to 2019. That again was when the company was repurchasing their limited partnership. It looks like they paid for that mostly with shares of the business. That does explain a good deal of this dilution. However, they've still been diluting existing shareholders throughout this period. So even after making that adjustment for their earnings, the company has still been diluting existing shareholders, and that dilution has outpaced how their earnings would have grown over this period, meaning that this is going to be an X here on metric number 3. Next up, for metric number 4, we're looking for something very similar. So here we're looking for free cash flow per share growth over the last 5 years. Again, we learned previously that their free cash flows have grown by more than 5 times over this period, and their free cash flows have been positive in all 5 of these years. This strong free cash flow growth does outpace their shareholder dilution over this time. And during their last 12 months, Williams has produced $2.51 of free cash flow for each share that they've had outstanding, meaning that this is a check here on metric number 4. So far, through our first 4 metrics, we're split evenly for Williams, 2 checks and 2 X's. Next up, for metric number 5, here we're evaluating how the business is utilizing debt. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. For most businesses, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the company has produced over the last 5 years. For Williams, as a natural gas pipeline company, just by the nature of their business, they're going to tend to have a lot more debt than a typical business was because they have so many fixed assets in place and these are relatively stable. So they're able to leverage these tangible assets in their business quite heavily, more similar to a real estate company. And in most years, the business is earning relatively predictable free cash flows because of this. Williams ended 2021 with over $22 billion worth of net debt. Currently, they have about $22.6 billion worth of net debt. And over these last 5 years, the company has only produced about $7.1 billion worth of free cash flow. Again, the company is utilizing a lot of debt in their business. However, to understand whether this is going to be a potential concern or not, you're just going to want to dig in and look at how this debt is structured, understand when it reaches maturity and what rates it's at. Over their last 12 months, the company has produced $3 billion worth of free cash flow. So their free cash flows have grown over this period. And depending on how Williams operates, a lot of these free cash flows could be contracted. Even still, it looks like the company has about 7 times the amount of net debt their current free cash flows could support. So it would still take 7 years worth of the business's current free cash flows to be able to pay off all of this debt. So this is going to be an X here on metric number 5. To have a true understanding and be comfortable with this business, you're really going to want to understand this debt position in more detail. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the yield of the 10-year treasury and potentially give us a reasonable starting point for a valuation of Williams. So we're using their total enterprise value because it takes into account both their market cap and their net debt position, and it's going to give us a perspective of the company that's more similar to as if Williams were a private business. So right now, Williams has a $63.5 billion total enterprise value, and we learned that over the last 5 years, the company has produced $7.1 billion worth of free cash flow, meaning that in an average year, the business is producing about $1.4 billion worth of free cash flow. So when we divide their $1.4 billion of their average free cash flow by their $63.5 billion total enterprise value, that only gives us about a 2.2% current free cash flow to enterprise value yield for the business. So that's less than the yield of the 10-year treasury, and that's less than half of the 5% risk premium that we're ideally seeking here. So this is an X on metric number 6 for Williams. When we look at the business's current free cash flows, again, they're producing over $3 billion worth of free cash flow over their last 12 months. And when we divide those by their $63.5 billion total enterprise value, That gives us about a 4.7% current free cash flow to enterprise value yield for the business. So that does look like that would be more attractive than what the business has been offering on a historical basis here. However, it's still slightly below that 5% mark we're ideally looking for, but it is above the yield of the 10-year treasury. So just because this is an X here on Williams doesn't mean that you're necessarily going to throw this business out. It just means that the company's abilities to produce free cash flows currently may be more fairly priced in by the market than some other businesses that we've looked at. And please keep in mind that this is just one of our 6 metrics. While these metrics are simple, when they're looked at holistically, they can be quite powerful. Then here as a bonus, we're looking at Williams' dividend profile. So again, Williams currently pays out a 5.4% dividend yield, which is well above that of the yield of an S&P 500 ETF. However, people make mistakes all the time by blindly chasing dividends. So it's important to stop and look at the underlying fundamentals of a business like we've been doing here today, and to understand whether these dividends are well supported by the company's earnings or their abilities to produce free cash flows depending on the type of business. For Williams, we want their dividends to be supported by their free cash flows, and unfortunately that looks like that's only been the case since the COVID-19 pandemic. They've only supported their dividend payouts with their free cash flows in 2020, 2021, and over their last 12 months. Their dividends were not supported by their free cash flows from 2017 to 2019. At the same time, the business has been steadily increasing their dividend payouts per share. So if you care about this company's abilities to pay dividends, it is a good sign that they've been supporting their dividends more recently. Although please keep in mind that the company's improved cash flows have come from potentially a variety of reasons, including a drop in their capex. You still want to understand if the business is adequately reinvesting into itself to maintain their existing assets or not. So that may just be one consideration you'd want to make here when you're thinking about how the company is using their free cash flows. And to understand management's perspective when it comes to capital allocation, you can read through the company's 10K to learn more. Then everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze Williams companies, which takes us on to using a discounted cash flow model to come to a potential intrinsic value for the company. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with the company's current free cash flows and using historical growth assumptions for how the business has grown these free cash flows over the past 20 years to project these out into the future. So it's up to you to do your own homework here to understand whether or not these historical growth assumptions are going to be potentially accurate and applicable going forward to give us a baseline projected estimate for Williams over the next 20 years. So assuming that they keep their free cash flows the same over the next 10 years, and then assuming that the business's free cash flows decline at 4% annually for the 10 years out after that, if we add in the company's tangible book value and we were ideally seeking a 15% rate of return from Williams today, then it looks like a fair value for their business is only around $18 per share. So that's more than $13 below their current stock price, and as such, it would look like the business is trending toward being in more overvalued territory, and that there would not likely be a margin of safety in today's current valuations. However, please keep in some caveats here. One, this 15% rate of return would be including their dividends, so we would not be doubly counting their dividends, and so 5.4% of this return would be coming from their current dividend yield. Then there are reasons why this may not be potentially accurate for the business. So again, it's really worth your while to dig in and learn more about the business. So please be mindful of the fact that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our summary for Williams, but we have to address something first. What are some of the qualitative aspects of this business, especially those that support the key points for either a short or a potential long thesis of the company? So starting with some of the key points that support a potential long thesis for Williams. Number one, Williams is leveraged to U.S. liquid natural gas exports via agreements with liquid natural gas terminals as a key supplier of gas. Number two, after several years of structural and financial moves, Williams is positioned to maintain steady dividend growth for the foreseeable future. And number three, a large, well-positioned network allows Williams to invest in high-return growth opportunities with minimal regulatory hurdles. Then for some of the key points around a potential short thesis of the company. Number one, Williams is focused almost exclusively on natural gas, meaning any upside in other energy prices will have little impact on earnings or valuation. Number two, Williams has written off over $7.5 billion in recent years as a result of overpaying for acquisitions. And number three, Williams had to abandon and write off its early investment in the Constitution pipeline when courts upheld New York State's refusal to grant a water quality permit. This highlights the permitting roadblocks pipeline firms face at the state level. So hopefully that offers a potentially balanced perspective around some of the key qualitative aspects of this business that support either a potential long or a potential short thesis of Williams. Now it's time for a wrap-up. So in summary, Williams checks the box on 2 out of our 6 metrics today. The company is earning slightly below average returns on capital, but they have grown their revenues and their free cash flows quite strongly over the last 5 years. At the same time, the company has diluted existing shareholders by about 47%, with much of that shareholder dilution, though, coming to buy out their limited partnership. Then it looks like Williams, as a liquid natural gas pipeline business, is employing a lot of debt, especially relative to their free cash flows in their business. If this debt is a potential concern, you would ideally want to dig in and learn more about the business and understand how this is structured. It does look like, compared to some of the other pipeline businesses that we've looked at, that Williams is employing just a little more debt than even they are. However, it's really going to depend on digging into the weeds here and understanding the details to know if that's a problem or not. Then, while the company does look like it's potentially attractive based off of their current free cash flows, on a basis of their historical free cash flows, it looks like their average free cash flow to their enterprise value yield in comparison to the yield of the 10-year treasury is well below the yield of the 10-year treasury, with their current free cash flow yield being slightly above that, but below that risk premium we're ideally seeking. Then it looks like Williams' improved free cash flows since the COVID-19 pandemic have allowed it to maintain a steadily increasing dividend payout that's been well supported by their free cash flows over their last 3 years. However, that was not the case prior to the COVID-19 pandemic. Finally, performing a discounted cash flow analysis of Williams, if you've done the work and you believe that those historical growth assumptions are going to be potentially accurate and applicable going forward for the company, and you were ideally seeking a 15% rate of return, then it looks like a fair value for Williams is about $18 per share. The last time the company traded around that stock price was back in April of 2020. The company fell much lower than that during their March of 2020 lows during the COVID-19 pandemic crash. So if you think that's a reasonable estimate of the company's intrinsic value, then you would just want to be patient as you do the work to learn more about the business. Again, it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Williams. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $119. That's just 33 cents per day through my referral link down in the description below. Normally premium is $239, but if you use my link, it's 50% off. So check it out if you're interested. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of this business, and you'll likely be able to determine for yourself what a reasonably appropriate intrinsic value for Williams will be. So as a value investor, you're ultimately trying to conduct this research as if you're going to own 100% of a business, and you can truly understand the ins and outs of that company and understand its underlying essence, knowing what's important and what's not important for the company going forward into the future. So with that said, that's it for today's fundamental stock analysis of the Williams Companies Inc., ticker symbol WMB. We looked at the business today as a continuation of looking at energy businesses and because the company has outperformed over the past year. So if you learned something and or you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Williams with me, and have a great day.